Hey everyone, it's Tony Leonardi, your certified financial planner professional from Newtown, Connecticut, and author of A Smarter Way to Retire. Back with another episode of A Smarter Way to Retire. Past few weeks we've been talking about live on versus leave on assets. The money that you'll actually spend during your lifetime versus the money that you hope you'll leave on to your kids, and how to make that distinction. Today I want to dig into why managing the live on portion of your assets is so different once you stop working, once you stop accumulating. Here's the core idea. Investing in retirement is not the same game as investing for retirement. There's a big difference. To understand why I'm saying this, let's first take a look at how investing works in your favor while you're still saving, while you're still accumulating. Most people are familiar with the concept of dollar cost averaging, whether they use that term formally or not. And here's how it works. While you're working and contributing regularly to your retirement plan, your 401k, your IRA, you're investing a set amount of money on a regular basis, on a regular schedule. Typically every paycheck or every month, the same amount of money goes into your plan. When the markets are up, that fixed contribution buys fewer shares, fewer of the more expensive shares. When the market is down, that same contribution amount buys more shares, more of the less expensive shares, more of the shares that are on sale. And everyone loves a sale, am I right? The same dollar amount every month buys fewer shares when the market is up and buys more shares when the market is down and prices are down. Over time, this process can lower your average cost per share. Market drops, while they're uncomfortable and they're not a lot of fun, can actually help you accumulate more shares for the same amount of money. So in your accumulation years, in your saving, in your working years, volatility often works in your favor because you have time and those consistent ongoing contributions on your side, which is why I really don't understand the one big mistake I still see people making in their working years, in their accumulation years, is sometimes they stop contributing to their retirement plan when the markets get tough. They think, oh, I should wait until things get better before I start investing in my plan again. That's a big mistake. Traditional dollar cost averaging is one of the reasons to stay invested and continue to contribute through market declines. This has historically been a smart long-term approach while you're still working. Buy those shares when they're on sale. Don't be afraid when the markets go down. Just tell yourself you're buying shares on sale. But when you retire, the whole game changes and you need to change with it. Once you retire and you start taking money out of your portfolio, the math flips and two powerful forces begin to work against you. Force number one is what I call reverse dollar cost averaging. In retirement, when the market drops, and it will, and you need to withdraw money to pay for your living expense, to pay your bills, you're forced to sell more shares to generate the same amount of income. Those shares are sold at lower prices and then are gone for good. They no longer participate in any future recovery. This is the exact opposite of what happened while you were saving. Instead of buying more shares when prices were low, you're selling more shares when prices are low. That's why I call it reverse dollar cost averaging. Let me give you a simple example of how this can really hurt your plan over time. Let's say we have two retirees, you and your neighbor. You both start with $1 million and you both withdraw $50,000 a year to supplement your Social Security and fixed income. Both of you end up with the exact same average return over your 20-year retirements. So you might think that if you both start with the same amount, earn the same amount of average return over time, and withdrew the exact same amount of money each year, that you would both end up in the same place, right? No, not necessarily. What have we not accounted for? The only difference between you and your neighbor is the sequence of those returns, not the average return over time, but when did you get those returns. One person gets stronger returns early on in retirement and then weaker returns later on in life. The other might get the opposite, might get weaker returns in the early years and stronger returns later on in life. Again, averaging the same return over time. But which one makes out better? What do you think? Even though their average returns were identical, the person who experienced the poor returns early on in retirement could end up with significantly less money and in many cases run out of money years earlier than their neighbor. Same average return, very different outcome. It's the order of those returns that makes all the difference. That's sequence of returns risk, which you hear me talk about so often. We can also call that reverse dollar cost averaging. Same results. The second force working against you in retirement is what I call the 50-100 rule. What is the 50-100 rule? Well, this force is just pure mathematics. If your portfolio drops, let's say 50%, many people assume that they only need a 50% gain to get back to even. That's not how it works. Let's say you start with $100,000. A 50% drop leaves you with $50,000. How much do you need to earn to get that $50,000 back to $100,000? You lost 50%. Do you need to gain 50% to get back to even? No. To get back to $100,000, that $50,000 now has to double. You need 100% gain to get back to even, not a 50% gain, which tells me it's pretty easy to lose money. It's much more difficult to make that money back. I call this the 50-100 rule. A 50% loss requires a 100% recovery just to break even. A 30% loss requires roughly a 43% gain to recover, and a 20% loss still needs a 25% gain just to get back to where you started. That asymmetry means that large losses hurt much more than most people realize, especially when you're also withdrawing money at the same time, which compounds the problem. When you combine reverse dollar cost averaging with the 50-100 rule, you can see why the first 3, 5, 7 years of retirement are so a significant market drop early on in retirement doesn't just feel painful in the moment. It can create a hole that becomes very hard to climb out of. I call this the retirement snowball. Once that snowball starts rolling down the hill, it's very difficult to stop it and turn it around. That's why simply chasing the highest possible return is often the wrong goal once you're retired. Reducing the size of the big down years can matter much more than squeezing out a few extra points of return in the good years. Controlling volatility is the key to retirement. So how do you protect yourself from these two forces that are working against you? First, separate your live-on money from your leave-on money. The dollars that you'll need to fund your lifestyle, to pay your bills, should be treated differently than the dollars that you intend to leave behind to your kids. Second, consider a bucket or a layered approach. Keep the first 3 to 5 years of expenses in cash or in very conservative investments so you're not forced to sell stocks during a downturn. This is called your early retirement income bucket. The next layer or bucket can be more balanced, and that's your live-on bucket. And your longer-term money, or the money that you intend to leave on to your kids and grandkids, can be invested for growth and handle a little bit more volatility because you're not withdrawing from that bucket on a regular basis. Third, look at adding more guaranteed income to your plan. Retirement isn't all about stocks. Guaranteed income can include Social Security and the timing of when you claim it. Also can include pensions and in some cases annuity income to help supplement. The more of your essential expenses that are covered by reliable, contractually promised fixed income, the less you need to withdraw from your investment portfolio during a down market. A good rule of thumb is to cover your fixed expenses with fixed income. Easy. Fourth, consider increasing more stable income sources such as bond interest or dividend income. While these are not guaranteed, they can still provide a steadier cash flow than relying solely on selling shares, which helps to reduce the pressure on your portfolio in a declining market. Fifth is stress Test your plan. We talked about this last week. Don't just look at average returns over time. Look at what happens if the market drops 20 or 30% in the early years of retirement while you're withdrawing money to cover your expenses. A good financial model lets you see the impact of that before it happens in real life so you can plan for it. Sixth, be thoughtful about your withdrawal rate, especially early on in retirement. Having some flexibility in your spending during the first few years of retirement can make a meaningful difference in your long-term plan. The goal isn't to eliminate all risk. The goal is to make sure that a period of poor returns early on in retirement doesn't permanently damage your long-term plan. If you're within 5 years of retirement or recently retired, understanding these two forces, reverse dollar cost averaging and the 50-100 rule, is one of the most important steps you can take. I've put together a guide called the Smart Tax Shield Legacy Playbook that covers several of the tax planning strategies that we've been discussing, including how to think about live-on versus leave-on assets. It's available for free. Just reach out and let me know you'd like a copy. It's also available on my website under the Books and Guides tab. Even better, I'm still offering to build your own smart retirement model at no cost or obligation while time slots are available. We'll look at your actual numbers, run sequence of returns scenarios, and see how resilient your plan really is. You can book a 15-minute call with me on my website at leonardifamilywealthcare.com. Look for my contact and Calendly links. Thanks for listening, and remember that investing in retirement is a different ball game than investing for retirement. Understanding reverse dollar cost averaging and the 50-100 rule are two of the keys to having a smarter retirement. I'll see you next week.
Securities and investment advisory services offered through Osaic Wealth, Inc., member FINRA SIPC. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth. The opinions expressed herein are for general information only and is not necessarily the opinions of Osaic Wealth or its representatives. Investing is subject to risk, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. It is not intended to provide specific advice or recommendations for any individual. Please consult your financial professional, attorney, or tax advisor with regard to your individual situation.